Welcome to the deep dive. Today, we're jumping into, well, the often pretty wild world of crypto trading. If you've ever been there, making those impulsive all-in calls, driven by emotion, not strategy, well, you know how fast that can lead to some really painful losses. It really feels like trying to sail in a hurricane without a compass.
Oh, absolutely. The crypto market, it rewards precision, discipline, and it just hammers impulse, right? But building that discipline, it feels almost impossible sometimes, especially when prices are swinging like crazy. Every single click feels super high stakes.
Exactly. And that's why for today's deep dive, we're going to unpack this really powerful kind of scientific concept that came up in the sources, what chart do, which, translates roughly to position sizing based on loss or maybe determining position size by loss. And this isn't just number crunching. Think of it more like putting on mathematical armor or maybe switching on a lighthouse in a storm. It brings this amazing discipline, this clarity to your trading.
Yeah, and our goal today really is to help you move past those gut feel trades. We want to give you a shortcut to understanding exactly how to control your risk, and maybe most importantly, how to actually survive and, hopefully thrive in this crypto world, which is, let's face it, incredibly unpredictable.
Okay, so let's start with the basic problem because undisciplined trading, it's just so common. We see folks using, I don't know, random position sizes or maybe sticking to a fixed size for every trade. Why do those old ways, so often just fall short on risk control?
Well, they fall short mainly because they ignore the human side of things and the market's reality. That emotional roller coaster in crypto, it's intense. You see a coin just rocketing up, and FOMO, that fear of missing out, it just grabs you. And it pushes you into these impulsive, often way too big trades. One wrong move there, and boom, your account can take a massive hit. Those traditional methods, they just don't buffer against that emotional pressure.
hmm So if that's the issue, how does this old idea come in and fix that? What's the core philosophy?
Right. So at its heart, honest garnies is a scientific way to manage your positions that puts risk control absolutely front and center. Every single trade decision starts with risk. And what's really cool about it, I think, is that it's not just some dry formula. It's actually this blend of math, trading discipline, and, this is key, emotional control. It kind of frees you from that emotional chaos we were just talking about, like having a rational co-pilot all the time.
I like that, a rational co-pilot. Okay, so let's get into the nuts and bolts then, the engine of this system, the core formula. What does it actually look like?
Okay, the basic equation is surprisingly simple, actually. It's just position size, account risk capital per coin risk value. But for actually using it in crypto trading, we usually expand it a bit. Position size, say in BTC, max loss amount in USDT, divided by the absolute difference between the entry price, USDT, and the stop loss price, USDT. That absolute difference part is important.
Okay, so two main parts there. Let's break down the first one, maximum loss amount, your account risk capital. How do you figure out that number? That seems pretty critical.
It is absolutely critical. This is the absolute maximum, the hard limit you're willing to lose on any single trade. It's a foundational choice. And typically, the recommendation is somewhere between 1% and 3% of your total account capital. Not just what you put in a trade, but the whole account. Choosing that percentage, it hugely impacts your ability to stick around long term.
Right, and why the range? Why choose 1% versus, say, 3%? Does it depend on how you trade or how much risk you're comfortable with?
It absolutely does, yeah. So the 1% rule, that's really great for beginners, or maybe people doing very short-term daily trading, or just more conservative investors generally. It lets you take quite a few hits in a row, maybe even 10 or more losses, and still keep most of your capital safe. It's a solid shield. The 2% rule is probably the most common, kind of the standard. It offers a good balance for most swing traders, solid but a bit more flexible. Then you have the 3% rule. Now, that's really only for experienced traders, people with systems they've proven have high win rates. And even then, usually only for trades they feel really strongly about, they're high conviction ones. Going over 3% per trade, well, you're starting to play with fire. A few bad trades can really, really hurt.
Okay, that breakdown makes a lot of sense. Now, the second piece, per coin risk value. Yeah. That's the absolute difference between entry and stop loss. Where does the stop loss price actually come from, and why is it so baked into this whole calculation?
Right, so that value tells you how much you stand to lose for each unit of crypto, like per Bitcoin, if the price goes against you and hits your stop. And the stop loss itself, it's fundamental because it comes straight out of your technical analysis, your read of the market. This is where your market judgment directly links up with your risk management. It connects the two, forming the basis for how much you should trade.
So if someone's trying to figure out where to put that stop loss, what are some solid ways to do it?
Well, common methods include putting it just below key horizontal support levels if you're going long, or just above key resistance if you're going short. Moving averages are another popular tool, like maybe below the 50-period moving average if the trend is clearly up. But what I personally find really effective and more objective is using volatility indicators, something like the average true range or ATR. For example, you could set your stop loss at entry price minus 2 times the ATR value. This lets your stop loss kind of automatically adapt to how choppy the market is right now.
And that 2 ATR. Why that multiplier is a reason 2 is often used. What's that helping with?
Yeah, good question. Think of ATR as measuring the market's typical daily noise or fluctuation range. Multiplying by 2 generally gives your trade enough breathing room so it doesn't get knocked out by just random market static, minor dips or spikes. It helps you avoid those really annoying whipsaw moments where you get stopped out right before the price turns and goes your way. So it balances giving the trade space while still having a clear, okay, my idea is wrong point.
Okay. So this is where it really becomes that mathematical armor you mentioned. The formula ties together your personal risk setting, the actual market signals through the stop loss, and then dictates your position size. It's all one integrated system.
Exactly. It's like a closed loop. It makes sure your risk is always defined up front, always under your control. It just removes the guesswork, the how much should I put on this question.
All right, let's make this concrete. Let's walk through a real-world example.
Yeah.
So for you listening, imagine you've got 10,000 USDT in your account, and you've decided, okay, my max risk per trade is 2%. So that's 200 USDT you're willing to potentially lose on any single trade.
Okay, sounds good. Scenario 1. Let's say you're bullish on Bitcoin, you want to go long. Your entry price is, say, $63,000. And based on your analysis, there's good support at $60,000, so you set your stop loss there. So your per coin risk is the difference. $63,000 minus $60,000, which is $3,000. Now plug it into the formula. 200 USDT max loss divided by $3,000 per coin risk. That gives you a position size of 0.06667 BTC. And if the trade does go south and hits your $60 key stop, your actual loss would be, just about $200, maybe $200.10 for the numbers. Right on target.
Perfect. Okay, scenario 2. Now you're bearish. You think BTC is going down.
Oh, okay, yeah.
You decide to enter a short position at $61,000, and you see resistance around $63,500, so you place your stop loss there.
Okay, so in this case, the per core risk is the difference between $63,500 and $61,000, which is $2,500, the same calculation. 200 USDT max loss divided by $2,500 per coin risk, that gives you a position size of 0.08 BTC this time. And again, if the market rallies against you and hits that $63,500 stop loss, your actual loss is exactly $200.
What's really striking when you put those side by side, I mean, different directions, different entry points, different stop distances too, right? $3,000 risk on the long, $2,500 on the short. But the formula just perfectly anchors that potential loss. It nails it down to your 200 USDT every single time. It feels like you're always keeping your hand firmly on the risk control, like a rudder, keeping the ship steady.
That's exactly it. It just highlights the main benefit. No matter how volatile the market gets or what the specific trade setup looks like, your actual risk exposure stays constant and, crucially, manageable. That's really the bedrock of trading responsibly long term.
That core idea is super clear now. But, markets aren't always simple textbook examples. What about adding some real-world layers? Let's dig into some more advanced techniques. This feels like where you go from just using GOT to really mastering it. First one, dynamic risk adjustment. Letting your position size sort of dance with your account balance. How does that add to the armor?
Yeah, this one's key for long-term growth and survival. The idea is simple but powerful. Your risk amount, that 1% or 2% or whatever, it should always be based on your current account value, not your starting capital. Think of it like an insurance policy that automatically adjusts its coverage based on the value of what it's insuring. It's kind of the opposite of the dangerous martingale strategy. It means when you're winning, your position sizes gently increase, helping your account grow faster. But crucially, when you hit a losing streak, your position sizes automatically shrink, protecting your capital during those drawdowns. It becomes this self-optimizing system.
Okay, next challenge, slippage. Every trader runs into this. What exactly is slippage and how do we account for it? How do we build in a buffer?
Right, slippage. It happens when the market's moving fast, and your order actually gets filled at a slightly worse price than you intended, especially with stop-loss orders, which often become market orders when triggered. It's like trying to slam on the brakes at a specific line, but your car skids a little bit past it, that extra bit. That's slippage, increasing your actual loss. So the solution is to be proactive. You basically adjust your stop-loss price slightly worse in your calculation formula. build in a buffer. So if your technical stop is $60,000, but you think slippage might be, say, 0.8% in current conditions, you'd calculate using an adjusted stop of $59,520, right? 60,000 times 1 minus 0.008. This will naturally lead to a slightly smaller calculated position size, maybe 0.057 BTC, instead of our earlier 0.0667 BTC. It's like pre-insuring against that potential slippage cost.
Okay, this next one feels huge because I can almost hear listeners thinking, okay, this risk control is great, but where does leverage fit in? There's this massive misconception, isn't there, that using leverage automatically means taking on more absolute risk per trade. What's the actual deal here when using ARCHA?
Oh yeah, this is such a critical point, and so many traders get tripped up here. It's vital to clarify. The truth is, the formula itself, already sets your maximum absolute dollar loss. In our example, it was $200. That number is fixed by your choice and the stop distance. Leverage. All leverage does is reduce the amount of your own capital, the margin or deposit that you need to tie up to open that specific position size. It's about capital efficiency, making your capital go further. It does not increase the $200 risk you already defined.
So the absolute loss stays at $200. How does leverage change the picture then? Maybe do that side-by-side comparison again. Risking $200 on that 0.0667 BTC position at $63,000 entry.
Okay, so no leverage, like trading on spot. To buy that 0.06667 BTC at 63K, you'd need roughly 202 USDT of your own money. If the stop loss at 60K gets hit, you lose $200. That $200 loss is about 4.8% of the capital used for that specific trade, $400. And crucially, there's no forced liquidation risk. Your account just goes down by $200. Now, let's say you use 5x leverage. Suddenly, you only need about $840 in margin to control that same 0.0667 BTC position. Much less capital tied up, right? If the stop loss at 60K gets hit, your absolute loss is still $200. That's the key point. But, and this is a big but, that $200 loss now represents nearly 24%, 23.8% to be precise, of the margin you put up, $840. It's a much bigger percentage hit on the capital directly supporting that specific trade.
Wow. Okay. Losing almost a quarter of your margin on one trade, even if the dollar amount is controlled. That feels risky. But what's the real danger then? If OSHU caps the loss, what's the looking shot with leverage?
The real danger, the one that bypasses your careful stop loss, is the forced liquidation price that leverage introduces. Exchanges set a price point where, if the market moves against you that far, they automatically close your position to prevent your account balance from going negative. You lose your entire margin for that trade. So if the market hits that liquidation price before it hits your $60,000 stop loss, well, your entire $840 margin gets wiped out. Poof! Gone. That's a loss way, way bigger than your intended $200. So you got to ask, what good is that carefully placed stop loss if liquidation takes you out first?
I see. So SHU sets the intended loss if the stop loss is hit. Leverage just lowers the upfront cost but makes the margin way more sensitive to price swings. And critically, it has that liquidation trapdoor that can completely ignore your stop loss plan.
You nailed it. That's exactly the dynamic. So the big warning here is never, ever confuse disciplined position sizing, like, ooh, dro, with just slapping on high leverage. Look, low leverage, maybe 2x, 3x, even up to 5x if your stop is reasonably placed relative to potential liquidation. It can improve capital efficiency. It frees up capital for other trades. But high leverage, it basically makes your stop loss irrelevant because liquidation is almost certainly going to hit first on any significant adverse move. Leverage should be seen as an accelerator for your strategy, maybe amplify returns if you're right. It's absolutely not a way to justify taking on fundamentally more risk than your plan allows. It's not a bigger engine for risk.
Okay, that clarifies the leverage question perfectly. So we've got the mechanics, the advanced techniques. Let's talk about the big picture benefits, the superpowers of using Tukura. Why is this so essential for listeners trying to navigate crypto? First one, enhanced trading discipline. How does it work as that sobering agent you mentioned earlier?
Right. Imagine Bitcoin just rips like 10% in an hour. FOMO kicks in hard, right? Everyone's piling in. That urge to just throw everything you have at it, go all in. It's almost primal. But hard acts like a circuit breaker. It forces you instantly to think rationally. Okay, the price is $70,000 now. Where would my stop loss realistically need to be? Maybe $65,000 based on structure. The formula immediately tells you. Position size, $200. 70K, 65K, $200, $5,000. $5,000 equals 0.04 BTC. Suddenly, your potential position size looks tiny compared to that FOMO urge. That quick objective math just chills you out. It acts as that instant sobering agent, stopping you from making those huge emotional bets. It builds discipline right into the process.
That's really powerful, how the math itself becomes the discipline tool. Okay, superpower number 2, optimize capital management.
Yeah. Because you're precisely calculating the size for each trade based on its specific risk profile, the stop distance, you end up allocating your capital much more intelligently across different opportunities. You avoid putting too many eggs in one basket, basically. It helps you balance risk and potential reward across your whole portfolio instead of just betting the farm on one idea based on excitement.
And number 3, maybe the most important, account survival. This really brings home that lighthouse idea, making sure you can weather any storm.
Absolutely. Look, trading isn't just about winning trades. It's about surviving the losing streaks because they will happen. Let's say you hit a really rough patch, 10 losses in a row. Brutal. But if you stuck rigidly to a 2% risk rule on each trade, after those 10 losses, your initial 10,000 USDT account would still have over 8,170 USDT left. That's roughly calculated as 1,001.0210. Now, losing almost 20% isn't fun, but you're still very much in the game. You have capital and probably more importantly, the psychological resilience to keep going and recover. Compare that to someone without this rule who takes maybe one impulsive 50% loss. That can be devastating, not just financially, but mentally. It can knock you out completely. Survival always has to be job one.
That math really paints a clear picture. Okay, and the last superpower, automatic market adaptation. You called it a risk auto-stabilizer. How does it adjust automatically?
Right. It's quite elegant, actually. It naturally adapts to market volatility without you having to consciously change your strategy all the time. When markets get really volatile, price swings are bigger. Support and resistance levels tend to be further apart. This means your stop-loss distance naturally needs to be wider. In the formula, a wider stop distance means the denominator, entry stop, gets bigger. A bigger denominator means the calculated position size automatically gets smaller. So you're risking less during choppy, dangerous times. Conversely, when the market is calm, but volatility is low, and you can often set tighter stop losses. Smaller denominator. Slightly larger position size allowed by the formula. It lets you potentially capture more profit when risk is perceived to be lower based on volatility. It dances with the market rhythm. And yeah, studies do suggest traders using this kind of fixed risk sizing have much lower chances of blowing up long term.
This all sounds almost foolproof if you follow it, but reality always has wrinkles. Where do people tend to mess up? What are the practical traps or limitations we need to watch out for when actually using FIM?
Oh, there are definitely pitfalls. Knowing them is half the battle. First one, pretty simple but often missed, forgetting transaction fees. Your broker takes a cut, right? So your actual loss will always be slightly higher than just the price difference times your size. Easy fix, though. Just slightly reduce your max loss amount in the calculation. Aiming for a $200 loss, maybe calculate using $195 or $198 to build in that fee buffer.
Ah, sneaky but simple. Okay, what about moving your stop loss after you're in a trade? I know people do that.
Yeah, this is a really common one, and it can subtly undermine the whole system. Let's say a trade moves in your favor, and you move your stop loss up closer to your entry price, maybe even lock in some profit. That sounds good, right? Protecting capital. But if you don't also recalculate and reduce your position size accordingly, your risk percentage relative to that new, tighter stop loss has actually increased. You might feel safer because the stop is closer, but if the market reverses and hits that new stop, the loss relative to that smaller distance could be much larger than your original 2% plan allowed for that remaining capital. So the rule is, if you adjust your stop significantly, you really should recalculate and potentially trim the position to maintain your original risk parameter.
Okay, that requires constant vigilance. What about just applying this to any coin? Like, can I use this on some random new altcoin?
I would strongly advise against that. This method really relies on decent liquidity. On very small, low liquidity altcoins, the order books can be thin. If your stop loss gets triggered, the slippage can be enormous. There just might not be enough buyers or sellers at nearby prices. Your actual loss could end up being way, way bigger than your calculated $200. It breaks the model. So yeah, stick to using this primarily on mainstream high liquidity cryptos, Bitcoin, Ethereum, maybe the top 10 or 20 by market cap where the markets are deeper.
Makes sense. Liquidity matters. What about just setting the stop loss badly in the first place, even with the formula, if the stop is junk?
Yeah. Exactly. Garbage in, garbage out, right. The formula is only as good as the stop loss input. Set it way too tight, trying to minimize that denominator. You'll just get constantly stopped out by normal market noise. Death by 1,000 cuts. Set it way too wide, maybe out of fear of getting stopped out. Well, then the required position size becomes tiny, or you're simply accepting too much risk before your trade idea is invalidated. It defeats the purpose of tight risk control. So the solution isn't just the formula, it's good technical analysis. Using those key levels, moving averages, ATR, whatever your method is, to find a meaningful price level where your trade idea is genuinely proven wrong. That takes skill and practice.
Right. So for someone who is disciplined, who sets good stops, could a downside be potentially limited profit? Because you're always forced into maybe smaller positions than you'd like to take.
That's a fair point, and it's the trade-off, really. Yes, accepting strict risk control often means accepting smaller position sizes than your emotions might scream for, especially in a strong trend. It might cap your maximum possible gain on any single rocket ship move, but that's the price you pay for ensuring survival, and survival has to come first. You can't profit if you're not in the game. Plus, there are ways to manage this. You can use partial profit-taking strategies, like maybe when a trade reaches a profit equal to twice your initial risk, a 2.1 reward risk, you sell 1/3 of your position, lock that in, then move the stop loss on the remaining 2/3 to your original entry price. Now you have a risk-free trade running on the rest, letting you potentially capture more upside if the trend continues, but you've already banked some profit and eliminated the initial risk.
Okay, that's a practical way to handle it. So we've covered technical pitfalls. What about the biggest hurdle of all? The one inside our own heads. Psychological execution resistance.
Yeah, this is, without a doubt, the biggest challenge for probably 90% of traders trying to implement any system, including this one. You know the rules, you understand the math, but then the market goes wild, FOMO kicks in, or maybe you just had 5 winning trades in a row and you feel invincible and you just abandon the rules. This time is different, right? The solution, it's pure discipline. You have to treat not as guideline, but as an ironclad law for your trading, non-negotiable. Maybe implement a mandatory pre-trade checklist, like a pilot before takeoff. Calculate position size, check. Set stop loss, check. Verify risk percentage, check. Only then execute. Keeping a detailed trading journal helps too. Reviewing your decisions, both good and bad, reinforces the lessons and holds you accountable. It's about building that mental muscle constantly.
So wrapping this up then, to recap for everyone listening, want is like your personal mathematical armor. It's not designed to magically predict where the market's going, but it is designed to make sure you never, ever sink your ship because of one bad storm, one bad trade. It builds that solid foundation.
Exactly. And it's crucial to remember it's not some secret formula for guaranteed profits. Nothing is. What it is the scientific cornerstone of sound risk management. The real path to mastery isn't just the formula. It's combining the formula with continuously improving your market analysis, getting better at setting those meaningful stop losses, and then having the unwavering discipline to follow through, trade after trade.
So here's a final thought for you to mull over. In a market where Bitcoin could theoretically swing from, I don't know, $200,000 down to $30,000, who knows, right? Always come back to this fundamental rule. Always use the loss you can truly bear to determine how much position you should hold. That's the piece you control.
Absolutely. Mastering this, practicing it consistently, that's your path to becoming a more disciplined, more rational trader. Because remember, in a market full of uncertainties, the only certainty you really have control over is your own risk.